Welcome back to Essential Dialogues. We always try to keep our finger on the pulse here and bring you deep dives into some really interesting topics.
Definitely keeping it fresh.
Well, today we're diving into something that's generating a lot of buzz of the Ethiopian Securities Exchange, or ESX for short, if acronyms are your thing.
Chitchy, right?
Definitely rolls off the tongue. But in all seriousness, this is new territory for a lot of investors. It can feel pretty overwhelming, honestly.
Absolutely. Especially with any emerging market. There's that mix of excitement and, let's be real, a little bit of fear of the unknown.
Exactly. But that's why we're here, right? To
Yeah.
break it down, make it digestible, and hopefully give you some really solid questions to ask yourself before you jump in. So think of this deep dive as your ESX cheat sheet, if you will.
9 key questions to get you started, like a roadmap for navigating this new landscape.
Love that analogy.
Yeah.
Okay, so let's jump right in. Question number one, and I think this is crucial for any investment, regardless of where it is understanding a company's financial health.
Yeah, you've got to start with fundamentals. It's like before you go on a road trip, you make sure your car's got enough gas, the tires are good, the basics.
Exactly. You got to make sure the engine's running smoothly.
Mhm.
So when we talk about financial health in this context, what are some of the things investors should be paying attention to?
Well, first and foremost, you want to see a track record of profitability. But, and this is important, it's not enough to just glance at the most recent year. You want to look for trends. Is profitability consistent? Is it growing over time?
So a consistent upward trend is ideal.
Ideally, yes. But even if there are some dips, you want to understand why. Was there an industry-wide downturn? Did the company make a strategic decision that temporarily impacted profits? Context is everything.
Got it. So consistent profits, or at least a good explanation for any inconsistencies. What else?
Debt. How much debt does the company have? Are they managing it well? A healthy debt-to-equity ratio is a good sign.
And how do you even begin to assess that? Like, what are the benchmarks?
Well, there are industry standards, but it's also really important to compare a company's debt levels to its competitors within Ethiopia. Are they in line? Are they outliers? Those comparisons can be really telling.
Makes sense. So we've got profitability and debt. Anything else we should be checking under the hood before we move on?
I'd say understanding how the company's financials compare to others in the same sector in Ethiopia. It helps you gauge if they're overperforming or underperforming, gives you a sense of their relative strength.
Great point. So let's say a company passes the financial health check. It's looking good. What's the next question on our list?
I think it's the question any investor should be asking: what are they planning to do with your money?
Right, because handing over your hard-earned cash is just the first step. You want to know it's being put to good use.
Exactly. You need to understand their game plan. Are they using the funds for expansion? To invest in new technology, maybe to pay down debt?
So you really have to dig into their plans and see if they hold water.
You got it. A company should have a clear and honestly compelling strategy for how they'll use those funds. And not only should it make sense for the company's growth, but it should ultimately benefit you, the shareholder.
Okay, so we've checked their financials. We like their plan for the future. But now we have to get into the nitty-gritty of the offering itself. And I'll be honest, sometimes reading through those documents can feel like I'm back in law school, deciphering ancient texts.
Oh, I feel you there. They can be dense. But just like with any important contract, you can't just skim it. It's important to understand the fine print.
So what are some of the key terms investors should really focus on?
Well, the offering price is obviously a big one. How much are they selling the shares for? Then there's the minimum investment. Some offerings have a pretty high bar to entry.
Meaning you have to invest a certain amount to even get in the game?
Yep. And then, of course, there are fees. Fees for buying, fees for selling, sometimes even fees just for holding the shares. Those can eat into your returns if you're not careful.
It's like buying a car. You wouldn't sign on the dotted line without knowing the full price, including all the taxes and dealer fees, right?
Exactly. It's about transparency and making sure you're comfortable with all the costs involved before you commit.
So we've talked about financial health, how the funds will be used, and all the details of the offering. I think it's time to address the elephant in the room, especially when we're talking about a newer market like the ESX. Risk.
Yeah, can't shy away from that. Risk is inherent in any investment. But emerging markets, they tend to have a bit more volatility.
Right. So how can investors try to assess the risk and then weigh that against the potential reward?
It's a balancing act, that's for sure. You want to look at a company's projected returns, their forecasts, and the overall industry outlook. But remember, projections are just that, projections.
So take those with a grain of salt. Factor in things like the economic and political climate in Ethiopia.
Exactly. Are there any specific risks tied to the company or its industry? For example, are they reliant on government contracts that could be unstable?
And then there's the issue of liquidity. Now, I've always found lockup periods fascinating, but they can also be a bit confusing for investors.
Lockup periods. Yeah, basically it's a period of time, typically after an IPO, where you can't sell your shares. Could be a few months, could be a couple of years.
So your investment is basically locked in for that time.
Right. And the idea behind it is to prevent a sudden flood of shares hitting the market right after an IPO, which could cause the price to plummet.
But for investors, it means you need to be okay with having that money tied up. You need to factor that into your own financial planning and timeline.
It's all about knowing what you're getting into, right?
Yeah,
Understanding the rules of the game.
absolutely.
Right.
Okay, so we've talked a lot about the individual company, but what about the bigger picture? How important is it to understand the competitive landscape in Ethiopia?
Oh, it's crucial. It's like you wouldn't invest in a restaurant without checking out the other restaurants on the block, right? You want to know who the competition is, what they're offering, what their strengths and weaknesses are.
So in this case, that means understanding who the company's rivals are, what their market share is, and whether they're growing or struggling.
Exactly. Is the company you're considering a dominant player in their industry, or are they an underdog trying to carve out a niche? And then you've got to think about regulations. Is the regulatory environment in Ethiopia stable and predictable, or are there potential changes that could disrupt the industry?
Right, because regulatory changes can make or break a business. And speaking of things that can make or break a business, let's talk about the people running the show. I mean, it's easy to get caught up in all the numbers and financial projections, but at the end of the day, companies are run by people.
Absolutely. And a strong management team can make all the difference. So how do you evaluate that? Well, you go beyond just looking at their resumes. You dig deeper. Look at their track record.
So not just what they say they can do, but what they've actually accomplished in the past.
Exactly. Have they successfully led other companies through challenging times? Do they have a reputation for making smart strategic decisions? Are they known for being ethical and transparent? These are all crucial factors to consider.
And sometimes that information can be harder to find, but it's worth the effort to really get a sense of the leadership team.
Totally worth it, because at the end of the day, you're placing your trust in these individuals to steer the ship.
Okay, we're in the home stretch here. Let's talk about dividends. For a lot of investors, dividends are a key part of their investment strategy. They represent a potential stream of income. So how should someone approach dividends when considering a company on the ESX?
Well, it depends if we're talking about an established company or a newer one. If it's an established company, you can look at their dividend history. Have they consistently paid dividends? Have those dividends increased over time? That gives you a sense of their commitment to sharing profits with shareholders.
And what about newer companies? Companies that maybe haven't been around long enough to establish a dividend history.
In that case, you'll want to look at their stated dividend policy. Do they have plans to pay dividends in the future? If so, when and how much?
And I imagine it's also important to think about how their dividend policy aligns with your own investment goals, right?
Absolutely. Are you primarily seeking growth, or are you looking for a steady stream of income? Your investment strategy should reflect those goals.
Right, because investing isn't just about picking individual stocks. It's about building a portfolio that reflects your risk tolerance and your overall financial goals.
100%. It's about putting together a puzzle where all the pieces fit together. So when thinking about adding an ESX investment into the mix, diversification is key.
Diversification. I feel like we say that word a lot, but it's because it's so important. It's basically about not putting all your eggs in one basket, right?
Exactly. And that's especially important when we're talking about investing in an emerging market, because, let's be honest, they tend to be a bit more volatile. So how much risk are you comfortable with? What percentage of your portfolio are you willing to allocate to the ESX?
Yeah, finding that balance, that sweet spot where you're participating in potentially exciting growth, but also managing your risk. That's the key.
And remember, it's a long-term game. Don't get caught up in the day-to-day fluctuations. Investing is about patience, about letting your investments grow over time.
Well, I think we've given our listeners a lot to think about today. We covered a lot of ground with our 9 key questions.
Yeah, we talked about everything from financial health to the competitive landscape, management quality, dividends, risk assessment, and the importance of diversification.
We really hit all the major points. So for everyone listening, remember, investing in the ESX can be an incredible opportunity, but it's important to go in with your eyes wide open. Do your research, ask the tough questions, and make sure any investment aligns with your individual goals and risk tolerance.
Informed investors are empowered investors. And hopefully this deep dive has given you the tools to start exploring the ESX with confidence.
I think so too. And remember, if you found this deep dive valuable, hit that like button, share it with your fellow investors, and be sure to subscribe to Essential Dialogues for more in-depth discussions on all things finance. Thanks for joining us.
Until next time.